Welcome back to Wealth Mavericks, the only show where we talk about the secrets the wealthy know to grow generational wealth. And on today's episode, we're talking about tax loss harvesting, turning your losses into gains, or at least into a smaller tax bill.
Your tax guy and your financial guy have no conversations.
That's so interesting, and that's so common. I used to say this all the time. When's the last time your CPA and your financial advisor, in coordination with your insurance agent, had a conversation about you?
Yeah.
And most people, it's like never. Something to pay attention to in 2024 is look at your tax return, and if you see a loss, that is greater than $3,000 and you have not recouped that, you haven't harvested that loss with some of your capital gains, then you need a different set of advisors. So I'm excited about today's episode. This is a really simple concept, Bob, that a lot of people I think are actually unfamiliar with. But once they understand it, I think it can really have a big impact. And I think I'm even more excited about our members only episode that's going to come from this too. So looking forward to diving into the content today.
Awesome. Yeah, no, it'll be interesting because, by the time people listen to this, again, the end of the year has gone, it's passed, we're in the new year, we're all excited and hopeful. And of course, we all got our shoe boxes out with receipts that we're going to send to our CPAs, and just kidding, please don't do that. So tax harvesting. What's it mean to you before we kind of dive into this? What's that mean to you? So when you have experience in the financial world and coaching and worked with advisors. So I think this would be an important question for you to answer, and then I can come back and add to that as well.
Yeah, so I learned a little bit about this when I was working in the philanthropy space for a foundation and helping people give, guidelines on how to give and all of that work. So tax loss harvesting, like if you had a stock, let's say you bought Apple stock, I'm just going to use round numbers. You bought it for $100 and it's now sitting at $500. And then you have losses or you have profit that you want to offset with, a capital gain or a capital loss. You basically want to sell that stock. So you're selling it higher to offset losses in other stocks that you have. And then you literally can go in and repurchase that same stock. But you actually experienced, you harvested the gain without paying taxes because you had this other loss. So That's kind of at a high level, that's how I understand it.
Yeah. Yeah. So I'm going to flip the tables on you and look at it from losses, harvesting profit.
Okay. Yeah.
Okay. And before I continue, this is just so you guys know, this is just educational information. We're not giving investment advice here. Even though we are fiduciaries, this is for educational purposes only. We don't know your situation. So we just want to be able to give you an idea of kind of what some of this terminology is from a high level perspective. If you are interested in something more specific, then you're welcome to reach out to us, engage us. Let's have a conversation and be a little more in depth, but please understand this is literally just do not take any action because of what we said here, because we are not giving you specific advice.
We can't know you and your scenario.
Not when you're watching us and we don't have eyes in your house.
Right.
Or your accounts, right? I mean, that's totally creepy.
We don't do that for our members either, though.
Right, exactly. So if we name you by name and we start talking about and we've never met you, something's wrong, right? It's more than Facebook.
Right.
So let's look at it from the opposite perspective. Let's look at it from a tax return on the capital gains. When you look at the Schedule D, the Schedule D is your capital gains, and so that's where when you're looking at, hey, I sold stocks. Let's just use stocks as an example. We could talk about real estate. We could talk about businesses. We could talk all these other assets. But let's just talk stocks because that's the most common. We've got a brokerage account. We sold stocks and we have a loss. And I see a lot of time on the capital gains line item, which summarizes the Schedule D, summarizes on page 1. And if it's a loss, it'll say negative anywhere from -1 to 3,000. It will never be over 3,000, even if your loss was over 3,000. Okay, so if I lost 30,000, let's use this example, my Schedule D, I have a negative 30,000. You're only allowed as an individual taxpayer to write off a loss of $3,000 a year.
Mm-hmm.
So that means it'll take 10 years for me to write off that $30,000 loss on my taxes.
And even if I have a loss the next year and the year after that, those
It'll
are
just
going to
keep
take
compounding.
year 12 and year 15, right?
That's right. That's right. So I bring this up, and the reason why I'm starting from this perspective is because when we look at tax returns and we do reviews, I can't tell you how many times I see a negative cap gain on a tax return, and I'm sitting there going, "Oh my goodness, they didn't have to do this. They didn't have to take the loss. They could have offsetted the loss with a gain."
That's really interesting. So the second you see their tax returns and you see that that is what's happening, you instantly know, hey, there's opportunity here.
Yeah. Yeah, because there's always a gain on the brokerage account. What we don't know from a brokerage statement is the length of time they've held that particular investment.
Mm-hmm.
So that's always the deciding factor. So it shows you costs basis, or what you bought it for, and it shows you market value and the gain or loss.
Mm-hmm.
Okay. What you don't see is 15 years, 2 years, right? Of how long they've held it. So whatever that gain is and whatever that percentage is, you divide the amount of years, and that's the average rate of return on an annual basis.
But from a capital gain perspective, that doesn't matter. It doesn't matter the length. It doesn't matter if it was 1,000 years or a day. Like, it's that gain is the gain.
That's right.
Okay, that's interesting.
So what is the whole purpose of buying or investing? It's for every asset, it's buy low, sell high. And I have seen gains of triple digits on brokerage accounts, and on their tax return, they've got a Schedule D loss of 45,000, and they're only able to write off 3,000.
Right.
And I look at their brokerage account and I see a triple digit gain, meaning percentage. How great of a return do you want? When I ask most people, what is that average return? What return are you looking for each investment? Most people say 6 to 8%.
Mm-hmm.
They don't say 15%. They don't say 100%. Most people say, I'm comfortable with just a 6, 8%. I just want, slow and steady. I'm good with that.
Right.
Because a lot of them understand risk and reward and all that kind of stuff.
Mm-hmm.
The reason why I bring this up is because that triple percentage gain, why in the world did we not sell some of that stock or that investment to offset the loss, to create capital liquidation, take your gains out of that particular investment and make yourself whole?
Right.
That $30,000, when you look at inflation over a 10-year period, becomes less and less valuable when it could be more valuable today.
Okay, so this is I think this is really huge. This is really good input for someone to think about if they pull up their tax returns. Where do I go if I'm pulling up my tax returns? I want to do a quick self-assessment. It sounds to me like maximum efficiency is a $2,999 loss every year, right? I mean, that in my mind, I'm like, that's how you maximize your efficiency. Meaning I have these capital gains in stocks or real estate or whatever it might be. Stocks is such an easy one because they're fungible. It's like you can move out of it and move instantly back into it and lose nothing. So if we just stay there, if they're showing a loss on Schedule D and they're showing this like gains on their stocks, that right there, if they did nothing else, it's like this should raise an alarm bell that says, I need someone to help me.
Yeah. Because I know your tax guy and your financial guy have no conversations.
And that's so interesting. And that's so common. I mean, this is one of the most, I used to say this all the time. When's the last time your CPA and your financial advisor, in coordination with your insurance agent, had a conversation about you?
Yeah.
And most people, it's like never.
And it doesn't affect the advisor. If there's an advisor on the account, for them to sell that, it does not affect their income.
Right.
They still have the assets under management. They're going to redeploy those assets into management into another lower, a valuable buy opportunity. They should be, right, to be able to get. Now let's use different assets. Now we're going to get crazy. They sell a piece of property. and they have a loss on the property, and they have a brokerage account and they have gains in the brokerage account. The Schedule D does not acknowledge the different assets. They acknowledge the gain or the loss
In capital.
in
That's
capital.
it.
That's it.
Capital gains.
That's
right.
it. The numbers, not the type of asset, the numbers.
Right.
So you could actually offset a loss on a real estate transaction with taking gains out of a brokerage account and take advantage of that liquidation and that capital, and the vice versa. You have a
Right.
loss on your stocks and you want to sell, you're selling a piece of property at a gain.
Right.
Right. You can reduce some of your gain on that property by selling off stock losses to
Right.
reduce your tax liability.
That, and I think, and this is the thing that kind of blows my mind, specifically with stocks, because people get like really wrapped around like the stock that they've got. You know, well, I've got this Apple, and it's usually around like these brands. It's not so much like you're excited about Procter and Gamble,
Yeah.
but it's like Apple or Facebook or any of these, and they bought it low and it's worth all this money, and they're very proud of that. And the point is, like, whatever your cost basis is when you bought that thing, it established like, here's what, when it goes above that, that is the capital gain. Again, some people don't understand this. So it's like now all of a sudden it's, you've got a 300 or 400% return on this stock that has performed very, very well. You literally can sell that stock right here. Your cost basis goes from here, and you can if you're just so excited about that stock and you can't have any other stocks, go repurchase that. And your new cost basis is up here, and you take that difference, and that's what offsets that loss. You literally only gain from that. It's like the government saying, hey, we know this was painful over here. We're going to help you recoup some of that painful, right?
Yeah. Yeah. So I mean, it's just interesting, but this is the value of understanding, you know, when you have an advisor and say they do tax planning, and that means that they use annuities, or they use cash value life insurance, they use retirement accounts, IRAs, they use 401k. That's not tax planning. Those are products that have tax benefits.
Right.
Tax planning is what we just talked about, is acknowledging assets. And what do I do with these assets to reduce or limit my taxes, but also create value in the capital and the investments and the assets I have?
Right.
That is tax planning. That's planning. And that is what is necessary and needed for people who work their tail off. They have assets, they have something that can create a gain or a loss. They deserve the right for an advisor or a professional to treat them just as valuable.
Right. So someone who's just looking at their tax returns, and again, from last year, and I know this episode is not going to come out until the new year, and so sorry for anybody who missed the opportunity in 2023, but something to pay attention to in 2024 is look at your tax return, and if you see a loss, that is greater than $3,000, and you have not recouped that, you haven't harvested that loss with some of your capital gains, then you need a different set of advisors. And, we are certainly here to help with that.
Yes.
But the bottom line is, like, pay attention to these signs, that are important.
Well, and that being said, because you are watching this in 2024 and you didn't have a conversation with your advisor or your CPA, your tax professional, before the end of the year about this, right? And now here you're sitting in a new year and none of that action or planning took effect, that should also be an indication for you.
Right. See, go back and watch our episode, that talks about tax planning versus tax preparation. And you'll understand a lot more about that. Yeah. Well, I know we're going to continue the conversation in the members only area, but make sure to join us on our next episode, where we're going to talk about what Albert Einstein called the eighth wonder of the world, which is compounding interest. And more importantly for you, how to use real tax advice and tax planning and tax savings as compounding interest. So thanks for joining the episode today with Wealth Mavericks. If you want to be part of the conversation, join us over on our LinkedIn page or Facebook page, or drop a comment in the YouTube video, and let us know what you thought about today's episode. And more importantly, let us know what questions you have.